Hi, welcome to the August. Oh my goodness, this year's going so fast. Version of transaction review and calculator practice. This is one of my favorite things all month to get to do, and but I'm pretty excited to share this little training that I've put together based upon a consulting client that I have right this very moment. So I think it's kind of instructive on a few different levels. And then at the end, if you have any specific questions about what we've talked about tonight, or just anything that's going on with you in particular, please feel free to raise your hand or put the chat, use the chat feature so we can connect a little bit. Okay, so this this is a flipping with owner financing question, and unlike a lot of the people that talk to me, these people are not in the business of buying cheap, rehabbing, and flipping. That's not their business. This guy and his wife, he's a realtor, and he's been trying to find his client a property, and they finally found a property that she wanted. I'm not sure if it was an REO or short sale or traditional sale, but he she couldn't qualify, and the reason she couldn't qualify is because she's self-employed, and so she didn't have enough income. They'd go only give her $100,000 loan. So so he decided that he and his wife would buy it for her, because I think he's the listing agent, so he double-ended the transaction from what I understand. So he went ahead, all cash, paid $192,000 for it, and he used an equity line of credit on his personal residence to do that. And he has a 4.6 variable on there, and like I said, he probably double-ended the commission, so I took 6% of 192,000 and just said, let's call that his commission. So he's going, well, we can buy this house and make this commission and do our client a favor by helping her get into a property she can't otherwise get into. So when they called me, when our first appointment was, they had already bought the property, and they had already agreed to sell it to their client for $195,000. And they said, we're going to go open escrow later today, as long as we know that we're safe. So let me pull up my calculator. Okay. So they were going to sell it just for $3,000 more, for $195,000, for a 13% down payment. Now, she is an owner occupant, so that's decent. 10% or more is good. 20% is better, obviously. More down is better in most situations. But she's got 13 here, so that's good. So if we take 195 minus 25,000, then that leaves him with a first note and deed of trust for 170. So we're going to put that in our PV here. The interest rate, now if you'll notice, they decided to give her the benefit of the rate that they got. They're just doing a favor. They're not trying to make a lot of money here, so they gave her 4.6 there, and they were going to amortize it over 30 years because and they're typical of most people. They think that they just think in terms of what the bank usually does, which is a low interest rate, 30-year fixed. Okay, now historically speaking, these are really, really low rates. So these aren't normal market rates, by the way. But anyway, people have gotten used to that, and they think they're going to continue. I'm not so sure about that. But so they put in a 30-year fixed. That's just what they're thinking. So then if we solve for payment here, we see that the payment was going to be $871.50. And they're going, well, and then we'll get out of the note, and we'll sell the note, and we'll get out of our position. They probably thought they would sell maybe for a very small discount, maybe $5,000 discount. And then they'd be ahead of the game because they made this big fat commission here. Plus they made $3,000 on the sale in 1 week without having to do anything. So that was kind of the thinking. So then they just wanted to make sure that they could sell that note, for a very uber small discount before they went and opened escrow later that afternoon. Any comments on this already? If you can talk, it's more fun, but here's something that scares me right off here. I'm just going to underline it here. They've got now let's pretend like they couldn't sell the note. They were going to hold it because they thought maybe they'd hold it for a while. But here they got a 4.6 variable. This could go up. If rates start going up, like what if this goes to 5 or 5.5 or 6? In the meantime, they offered her a 4.6 fixed. So they could be going and having a negative cash flow on this, right away. So basically, they don't have the liberty with this kind of a thing here. They really don't have the liberty, since it's secured by their personal residence. That's just kind of freaky to have something sitting there against your house that could go crazy. Nobody knows. We all heard stories, what happened when interest rates went through the roof in double digits in the 80s. So anyhow, just that's what we're sort of thinking about. So then here we have the deal that, so we're trying to figure out what will the note sell for. Okay, so over here, let's just say I told them most note buyers, and I'm not even talking about myself here, because for them to get top dollar, I really can't buy this note for my own portfolio. This has got, if he's going to get decent pricing at all, like what most private investors need more than some of the institutional buyers. Some of those larger banks or hedge funds that are buying, they're the ones borrowing 2% money, so they can afford to buy at 7 and 8 and 9% yields and have loan to values and investment to values that are much, much higher than most private people should reasonably do. There is a bit of I would say, irrational exuberance in the market right now. So there's a lot of people paying more than they should, but I don't mind these big funds. But so just keep in mind that I'm already knowing that I'm not going to buy this note. I'm trying to set them up so that I can help them get the highest possible price from some of the funds that I know that like good A paper and will pay like a really good price for it, more than I could pay. I mean, minimum, I'm going to have to make 12 or 13% usually on anything. That's the minimum. So just FYI. So I'm going to say those people are going to want to usually see 3 months of seasoning. Some will, but not all. They don't like to buy simultaneously right at closing, because then it gets confused with an origination, like you're lending money. And then at that point, you're subject to Dodd-Frank and all of the crazy, crazy regulatory things that are happening in the lending world right now. So I told him you're going to have to hold it for 3 months. And at that point, your note balance will be 169,780. So basically, there's 3 easy ways to do it, but the quickest way on here is to use the shift button and hit the amortization button right here. And so then that brings up our amortization schedule, and you could see if you go 1, 2, 3 at the end of the third payment, that's what the balance will be right there. And so we know there's a 13% down payment. The property value is anywhere between what the realtor bought it for all cash and what he's selling it to his buyer at 195. Now, this is really great. She's got a credit history or a credit score of 800. Excellent, excellent credit. So that's why I know some of these institutional buyers are going to snap this up at really good prices, because they like this kind of paper where there's a decent down payment and a really high credit score. Okay, and they want to know that this value, like if they did an independent appraisal, that it would come in at this, and I'm pretty sure it would. So now, if it were me, the first thing I do figuring out how much I can pay for this note is I would figure out what's my ITV, my investment to value maximum. And for me, it's 65%. So rarely does it go over this. It has to be very extraordinary circumstances. So if I take the value of the property, and I'll even give them the benefit of the doubt at the 195, times 0.65, that's the most I'm going to pay for this note, no matter what the yield is. Okay. Now, some of these funds, they're going up to 85% investment to value, sometimes even higher. But they're assuming a 9% or a 10% down payment on most properties, and then they're buying that paper sometimes at 90 cents, even 94 cents on the dollar. So they're sitting somewhere around 80 to 85% maximum ITV. So look, they can afford to go up to 165 before they'd probably hit a threshold there. Okay. So continuing on the conversation with the next slide. So we know we have this monthly payment, $871.50 right here. And after that 3 months of seasoning that I told her she was going to need to have, so now we only have 357 payments. That goes in number of payments, number of times that you're going to receive this right here. And then I have to plug in a yield. Now, like I said, if it was me, I'd be plugging in 12%. Like that's what I'd want to buy this at, especially with such a long term, right? That's a long way to go out not knowing if rates are going to go up. So if I hit PV, all I can pay is 84, let's call it $85,000. Wow, that's basically 50 cents on the dollar, isn't it? If we plug in 10, it's that. But if I go down to what I think one of these funds, I think they'll like this paper because of her credit score and a decent down payment. And if I put in the 8% there, but still, okay, that's still 118. And that's a lot better than what I could pay. But still, if you take that plus the down payment money they got, plus that big fat commission he got, what's he gonna do? Whoa, he spent $192,000 plus closing costs, and he's gonna lose this much money. That's not even counting closing costs, right? He's in the hole 36 grand for doing his client a favor. First he thought he was gonna really come out ahead, now he's going retro. So basically now we have to go, well, now what should we do then? He didn't like that story. So now we're talking, what are the options? So, basically the only thing that I'm showing you here is that I netted to the seller, and this is minus, I took out the commission thing. But if I just go down payment plus what he can sell the note for with his initial idea, he's only going to make $143,000. Okay, net to seller. Now, someone who inherited this property and didn't put a dime into it, they might be happy to do that. Or someone who bought it, for $25,000 30 years ago, they might be happy to do this. They're going to defer capital gains. They're not going to sell the note. Maybe when they die, their heirs and beneficiaries will think of selling the note, or maybe after a while, statistically speaking, this will pay off in 7 to 10 years, something like that. But for him, he just put in 192,000, cold ones. So that isn't going to work. So we talked about, okay, what can we do? So let's just try changing one thing. All we're going to change is the term right here. So let's go back to our original note, 170,000, put it in PV, present value. That's also loan amount if you're just figuring it as a loan. The interest rate they told her they would give her 4.6, but instead of 360, let's do 180. Okay, now her payment goes up quite a bit, $400 or $500 there. And but if we plug in that same 8% yield, and then that the investor, the note buyer, would want, then I do 180 minus 3, the 3 months of seasoning. Now I'm going to solve for present value. Okay, what would that payment stream be worth to me? 177 of these if I want 8%. Now I can pay 135,799. 8% yield, 177. Now he's netting 161 instead of 143. So there again, can you see that by a little change, like if someone did inherit this property and they were going to offer owner financing and they knew that they were going to sell the note, can you see how they just knowing this little trick alone, can you see that that was worth, what is that, $17,000 put in their pocket right then? Most people have no clue how powerful that is and how that works. Okay, now he could do that, but let's make it better. Can she not only pay a 15-year because she has great credit and she has good income, it's just that it's not all documentable or it doesn't qualify for traditional underwriting. But if she can afford this, let's see what else could she do. If we take this 180, put it back, and take the 170, we need to get back to that again. Present value right there. Do you think she could pay 7%? And he says, well, I don't know. I said, well, why would you offer her 4.6% when that's the going rate at the bank? And she can't get that. You're providing a service, so it's at the minimum, you should be charging 2 points above the going rate, and usually it's more. Owner finance is very common, at 6.5 to 11%, all in there. I've seen lots of it at 7, 8, 9, and 10, and much higher in states that don't have usury limits and things like that. I have a couple of notes that are at, I think, 11% in Florida, where they have high usury there. But anyhow, so let's see if she puts 7. Now, I have a feeling that's going to be good because 7's a lot closer to 8 than 4.6 is. So that's not very far from where the investor wants to be. So basically, if you had an investor who would buy at a 7% yield, basically they would buy at par. They would pay the balance of the note just to have it on their books. Generally, there's a little bit of a discount because of closing costs and things like that. But sometimes not. I guess if this institution might want it, they'd pay. But you can see that we're getting a lot closer here. So now let's see what the present value would be. Oh, I have to go down to 177, right? 3 months of seasoning. So there's 170. Oops, I didn't calculate for the new payment yet. Got ahead of myself. Okay, so the new payment would be $1,528. So as long as she can afford that and it's staying within normal debt to income ratios, this is a great option. She pays it off sooner. Her financing charges overall are a lot less. And then if they want to sell this note, and let's assume they can get 8%. Okay, now we're at 158,496. Okay, pretty good. That's getting better and better and better, right? So now the net to the seller was 143. Then it was 160. Now we're 183. But you can see that he's still gonna be underwater, isn't he? Even if we count in his big fat commission, he still lost money because closing costs, and he doesn't still come up with 192 there. I don't think. Well, maybe barely. Okay, so but why do all that work to just like wash even? Still not good enough, right? The next thing then. So we could do that, but what if she says, whoo, that's a steep payment for me. That's a little bit much. I don't know if I can commit to $1,500 a month. So, well, let's keep the interest rate the same, everything the same, but we'll just extend the term out a little bit more. So instead of the 180 that we had before, let's take it back out to 360, but keep the interest rate up, which is quite a bit higher than 4.6. Okay, now what's our monthly payment going to be? Solve for payment. Okay, now, okay, that's getting better. That's only $300 more than the 4.6 30-year amortization. So let's see what happens when the guy goes to sell the note this time. 357, 8, And PV, solve for present value, 153. Pretty darn good, right? So you can see that the rate and the term are both hugely, hugely powerful in determining what this note will sell for. Now, he's still going to go down some. Uh, you know, he's still going down, but preserved the value quite well, even with this long, long term. You know, these long terms, because of time value of money, those payments, this $1,100 that's coming in 30 years from now, that's not going to buy half of what it buys now because of inflation. You know, things will be so much more expensive: food, gas, movies, rent, mortgages, all sorts of things. Okay, so the most valuable part of any payment stream is the first 5 years. Anything in the first 5 years retains a reasonable amount of its value. After that, it starts dropping off dramatically, with these things here in the last 10 years worth very, very little as a percentage in terms of today's dollars. So, but still pretty good. You know, he would do okay. There again, somebody who inherited the property or bought it, you know, for 20,000, they're going to be okay with this strategy. They'd probably be thrilled with this strategy. But here again, he's not. All right, so what else can we do? That's what we just had. Now let's do another twist. What if she can put 20% down? Because then that uber shoots her over into the AAA paper, because not only does she have an 800 credit score, but this is a traditional, by all the, you know, conventional thinking, 20% down and more is a real sweet spot. Okay, so what if she could put 39,000 down instead of 25,000, then the first note in deed of trust would be 156. So let's make this payment. So, and obviously the more that he gets in the form of a down payment, there's no discount to any of that. That's just cold hard cash that goes on his side of the equation. So if she could put 50% down, so much the better. Then he's only, you know, got half of the note, and it'll be a really, really small discount because of the equity position there. But anyway, so 156, let's say she can swallow the 7%. She understands that she has to pay a premium for the financing. And when they were kind of shocked. How could we charge somebody so much? And I said, now think of it. You know, you're just so used to thinking of people getting really cheap loans, but what if, because she can't get a bank loan, what if she had to go and get private money? What if she had to go get a private loan from somebody? What would she be paying? And they said, well, she'd probably have to pay 2 or 3 points. And I said, yeah. So right off the bat, she's looking at $2,000 or $3,000 or more, whatever, 150, three to $5,000 maybe in points. And she'd be paying, I guarantee you, at the minimum 8, more likely 9 or 10%. And she would have a short-term balloon anywhere between probably 2 and 5, maybe extraordinarily out on the far end, you know, 10 years or 8 years or something like that. But probably she'd have a short-term balloon there. And they were very uncomfortable. They did not want to put a balloon on her because they thought it would be extremely awkward to get to that point when if she couldn't refinance, then they'd be in a real pickle, and they didn't want to do that, which I think is smart for them. Plus, just a point here, a lot of these buyers that I'm talking, you know, some of these funds that are paying these really good buying notes at 7, 8, 9%, even if there's a short-term balloon, they usually buy as if it's not going to pay off. So they'll fully amortize it out because they understand that there's a good chance that some of these balloons, when they're coming due, there won't be affordable financing, or prices might have gone down, so the appraisals won't come in, all sorts of things. So not everyone, but a lot of the big buyers will buy right through a balloon and pretend like it's not even there. They'll pretend like it's a fully amortized note because they're not going to want to foreclose on these people. So if it does pay off, then they get a nice bump to their bottom line, right? If you buy a note at 8% interest, that if it takes 30 years for it to come back, and it comes back in 7 or 5. Wow, you really went from an 8% at least up to a 16% yield, if not more, on some of those. So just saying, there's a lot of factors in here. So I keep getting distracted. So let's go back to a 360 note 7. Oops. 357, and we're going to sell this note. Okay. Oops. Oh, I got distracted again. Oops, not that. I love this little back button right here. That saves me a lot of redos. Okay, 1037. So that's a really nice payment, right? Her payment's lower because she put down more of a down payment. And if someone's going to buy that, 357, sell it to a hedge fund, and then they'll pay 141. Okay, so then he's back up to getting 180 again. So not bad. And keep in mind, though, that we haven't talked about broker's fees yet, right? This is only what, like, if you found someone who had this kind of a note, and since I can't add this to my portfolio, I'm going to just make a broker fee when I help them sell it to a hedge fund. So I told them that just like there's real estate commissions, there's commissions on the sale of a note. So I told them this is going to be very similar, a 5 or 6% commission, and they totally understand that. Okay, and this looks to be, wow, this looks to be our highest so far. He's gonna net 184, so that's the highest we've gotten. If you add his 11,000, then he made 195, but then he probably washed because of closing costs on both sides too. So anyway, this still isn't very fun, but this is the best number so far. And all we did is we took, if we go 177 here, what we'll pay, and by now this should be so nauseatingly simple that you're just bored of me seeing it, but at that point you can see how you just go back and forth around on these numbers, around and around and around. Okay, so interesting there. So then just a little quick graph that I thought maybe would help. This isn't the 20% down payments, but this is the 13% down payments. So this is the 15-year amortization. This is the 30-year amortization. The blue is the 4.6% interest rate. The red is the 7% interest rate. So it's just really interesting to see, based if someone needs present value to be as high as possible, then you can see that the best option is going to be for a 7% 15-year am. That's the absolute best. But frankly, if they were old people and they wanted to defer capital gains and they just needed income for retirement, they'd probably want to go with the 360 because there's so much money that comes in. By the time you finish paying off a loan, you've usually paid 2.5 to 3 times. So when you're the bank, you collect a lot of money. But so the best option for present value is the 7%, the highest interest rate she can do, the shortest term she can afford. Second best would be the 7% and 360. You can see that if you're going to have a really, really low interest rate, there's a big difference between the term there. So first, second, third, fourth. Unless your point is not present value, unless it's cash flow, unless it's deferring capital gains, unless it's just the overall total amount collected. So any comments, questions, things like that, feel free to drop in. Other things they said, well, oh my gosh. Now, and I forgot to tell you that I also worked up numbers where they could sell a partial. They could take the 13% down payment, and then I could give them something like 63,000 for the first 5 years, and then they could keep the remainder. So at that point, they would be getting, let's say, 25,000 plus 63. Let me see if I remember what it was. They'd get the down payment of 25,000. Oops, back up. And I would pay them the, let's call it, I think my top number would be 63,000 for the first 5 payments, for years worth of payments. Okay, so they could get 88,000 now, and they could put that right against their home equity line of credit to pay it down and reduce the risk that they have. Because if, like I said, if interest rates go up on them, they could be in a pickle real quick. So they want to be, paying that down. But if they could get that, and then when they get the note back, look at this. And I think this is assuming the 7%, 15-year. Okay, and I think I said, I wonder if I really did remember this right. If I'll pay them 63, I wonder what my yield would be. So 5 years, 60 months of this payment, I'll pay 63,000. Yeah, I'd do that. I remember that right. Okay, so then let's find out what the balance of the note would be when they get it back, if they wanted to play, be the bank. So we're going to recreate the note here. Oops, I'm sorry, 170. Okay, so now I'm just going to do Shift, Amortization, and I'm going to go down to 60. And I see that, wow, if I buy the first 5 years worth of payments for 63,000, when they get the note back, they'll still have a balance of 131.6. Okay, and so they could look at that like, okay, we'll have a note balance of 131.6 when we get it back, and we can either keep that, maybe they have found other ways to pay off that equity line of credit, or we could sell off another chunk if we wanted to at that point, because the next 5 payments, once you get there, are you take a lot less of a discount. So they could get that 131 balance, the 25,000 down payment, and the 63,000. Look, total to them, you could make the argument that they could make well over what they have in it, 219,600. It's not exactly taking into the consideration all the time value of money, but sometimes this looks really attractive to people, and it's a good option for them. So that's another thing that I threw out there to them. But I told them there again, it might cost you a couple thousand if 63 times, it might cost them $2,500 in broker's fees, closing costs, and things like that to sell that note. So that I didn't count that in there. They also could have done a lease option, or he could have said, maybe I should just take out a loan against the property. Remember, he owned it free and clear because he used the line of equity against his other property. But if he would take out a loan against this property that he just bought, he can get an investor loan at probably 5.5%, 30-year fixed, with which he can pay off his equity line of credit. And then he can owner carry that, leave that financing in place for the buyer. So he goes, well, isn't there a due on sale clause? And I said, yes. So there's a relatively small chance that will be a problem, and you can take your risk, and the buyer can take the risk for the chance to leverage your existing financing, or you can do a lease option so that title doesn't really change, or you can put it in a land trust, get the financing, close on that, put it in a land trust, and then sell the beneficial interest in the land trust to her on terms. So now you're selling personal property instead of real property, and this has the best chances of protecting the existing financing, as well as, since title isn't in the buyer's or the seller's name directly, then none of their liens, judgments, bankruptcies, or other weird things can attach to the property. And so both of them are actually better protected. So anyway, that's my little case study. They're still trying to figure out what they're going to do, so we don't know the end of the story yet, but I thought this one deal gave us a lot to think about. Thank you so much. I appreciate you. Thanks for tuning in, whether it's live or after the fact. This has been Transaction Review and Calculator Practice, August 1st, 2013. We are taking, I'm going to be out of the office most of this month, so our next scheduled event will be virtual coffee the last Saturday of the month, and I really love it when you guys tune in for that. That's a whole lot of fun. So anyway, you guys hope you're having a great summer. Keep up the good work, and we'll talk soon. Take care. Bye-bye.